Hello, I'm Tim Ogden, Managing Director of the Financial Access Initiative, a research center housed at NYU Wagner focused on how financial services can better meet the needs and improve the lives of poor households around the world. And it's very good to be with you this year. The last time I spoke to an MFC conference was in Istanbul in 2019. And I'm sorry that I can't be there in person this year, but very pleased that MFC has continued its important work supporting microfinance in Eastern Europe and the former Soviet republics. I'm here today to talk about what's next for microfinance based on what we've seen for the last year and a half. And if you follow anything that we've done at FAI, you're probably aware that I was one of the people at the beginning of the pandemic talking about the very dark clouds confronting the industry, that the pandemic was an existential crisis for microfinance, different from other crises we've seen in microfinance. That this was the first time we'd seen a situation where both local economies and the global economy were disrupted simultaneously, and that would present both challenges for customers, for borrowers, for customers of microfinance, and for the MFIs themselves in accessing funding, because funding would be tight from funders and governments alike. And so I perceive that this could get very, very bad. What we've seen in the last year, though, is that the picture has looked more like this. Certainly, there are plenty of dark clouds, but we've also seen an incredible amount of resilience from microfinance institutions and NBFIs and others providing financial services to low-income households around the world, and lots of possibilities, lots of resilience, lots of reason for optimism and hope as these institutions have responded to the needs around them and supported their customers through this very challenging time, supported their staff, supported their communities. And so I want to begin by saying, I was one of those people who was very pessimistic about what we would see. And I've been very, very happy to see that my predictions have not been borne out. Now, FAI has been a hub for something called the Sentinel Project, which is something that we launched this spring. The idea is of the Sentinel Project is to track what's happening in global microfinance, not systematically, with hundreds or thousands of MFIs, but with some key microfinance institutions around the world, what we call sentinels, and keep track of how they're managing. So over the course of the last 6 to 9 months, we've been regularly interviewing a team of researchers has been regularly interviewing MFIs from various parts of the world, including participation from MFC and a number of MFIs that are part of the Microfinance Centers Network. And we've seen, obviously, a lot of difference, but a lot of commonalities. And as I said, a lot of reasons for hope and encouragement as the MFIs have been managing staff, figuring out how to keep staff safe, but also employed with regular income, helping customers manage the situation that they're in with lockdowns and shutdowns and restarts and emergency liquidity. We've seen MFIs evolving their operations, trying to figure out how to use digital tools, both to receive payments and to connect and communicate with customers and to support staff. We've seen some really interesting, innovative products, new liquidity loans, new restart loans, various kinds of grace periods and other ways of allowing customers to stay in good standing while recognizing the situation that they're in. And we've seen a good amount of support from regulators, government agencies, and funders to make sure that MFIs could continue their vital work. I'd like to ask everyone to keep track of the Sentinel Project. You can find it on the financialaccess.org page. We've just been publishing some of the results from our first rounds of interviews, and you'll continue to see things there over the coming year. And we'll return to this question of how the crisis has evolved a bit later. Now, I wouldn't be me if I didn't come at this and say, despite the silver linings we've seen on some of the dark clouds, I still think what's ahead is a very uncertain path. It's really not clear where we go from here for many institutions. for many countries, for many sets of customers. Because the pandemic is not over, we're seeing surges. We likely haven't seen the last variant of the COVID virus. Vaccination rates and the availability of vaccines are still proceeding far more slowly than we could hope for. And so it's unclear how economies, how customers will evolve and adapt, how MFIs will adapt to the uncertainty ahead. And so I want to talk about what we see and the possibilities, but also some concerns about what's coming in the next year for microfinance. So as we think about that road ahead, first I want to note that there's a phrase common in financial circles and repeated financial crises that just before things get out of hand, you'll hear someone say, you don't need to worry about this bubble or this mania because this time is different. And so when I saw what was happening with the pandemic, I had a lot of concerns based on the historical record for what is a very, very long history of microfinance. If you saw my talk in 2019, you'll recognize some of these pictures as we talk about, microfinance. The industry today likes to think of itself as a relatively recent innovation, but the idea of credit for lower income households and businesses is by no means new and goes all the way back to Hammurabi. That second picture is Jonathan Swift, who invented the product of microcredit almost exactly as we practice it today in the 1600s. In Germany, in the 1700s and 1800s, we saw rural credit cooperatives doing much the same as what rural microfinance does today. France had a huge industry of peer-to-peer small-scale lending and banking that was sort of hidden from ideas of how banks really worked. In the United States, in the early 1900s, the microfinance industry, although it wasn't called that at the time, was so widespread that there were many, many studies commissioned to understand what was happening with these small loans, as you see the title of that book, 10,000 Small Loans. So we have a lot of history to draw on to understand what's gone on with microfinance in the past and what's happening now. And one of the reasons I was concerned is that you get these fairly common historical cycles where when a crisis arrives, the financial services institutions for lower income households are the first ones to die. They're the first ones to die for two reasons. One, because the economics of providing credit and savings to lower income households in small amounts is very, very difficult. It's very, very hard to do it well, and to do it sustainably. And so when crisis hits, that hits those lower income households harder and therefore hits the financial institutions serving them harder. Second is that historically, the institutions that provide financial services to lower income households have been perceived to be the least important financial services institutions. And so regulators and governments didn't really think it was worth saving those institutions, supporting those institutions. They focused on the larger banks. And so the reason I draw this out is this time, at least so far, what we're seeing is something very, very different from historic crises that have affected financial services institutions. This time we have seen widespread and broad recognition of how important these institutions are to economies overall and to the households that they serve, and a great deal of support. And so one of the commonalities we've seen is that I was, coming into this, very worried about funders pulling back. And what we've seen is, in many cases, the exact opposite, is that governments and funders have stepped up to support the financial institutions, recognizing how important microfinance is to low-income households. And so that's a very important fact to recognize and lays the possibility that what comes next is we're going to see those additional rays of light in the microfinance industry being well poised to play a vital role in recovery for households, small businesses, and overall economies. But to do that, microfinance, I think, needs to continue to evolve what it is and how it conceives of itself. Again, in my presentation a couple of years ago, I talked about really rethinking what the purpose of microfinance is. we have had this story that microfinance is primarily about small business credit to fund growing businesses. But the reality is that we don't really see that in practice. We don't see the idea that microfinance loans are transforming businesses, creating lots of growing businesses with lots of employees, raising incomes. But that does not mean it's not important. What we've come to understand over the last 30 years is really seeing the lives of the kinds of customers that are microfinance clients and understanding them as requiring three basic things, some three very basic needs. And this pyramid that you see here is based on Maslow's hierarchy of needs. And I think of this as a hierarchy of household financial needs. That first and foremost, households need to be able to manage liquidity. When they can manage liquidity, the ability to move money from one time period to another so that they can spend when they need to spend, they can save when they need to save. Once they can do that, then they need tools to manage investment, because almost every household does want to invest. They want to build a better future for themselves. So they need a way of accumulating enough money at one point in time to buy something, to invest in something that's going to provide future income. And of course, because these households are exposed to a lot of risk, they need the ability to manage those risks. Another way of thinking about this is that the lives of customers are shaped by three key concepts, three key ideas. So historically, we've thought of poverty primarily as insufficiency. Insufficiency meaning you just don't have enough money. And that is absolutely true, but it's not the whole picture of poverty. In fact, it leaves out some really important factors of poverty that we have to take into account if we're going to design the products that people are going to need to recover from the pandemic. So it isn't just that they don't have enough money. It's that their incomes and their needs are unstable. They face a lot of instability. Those incomes vary up and down during the course of days, of weeks, of months, of years. And so even if they have enough money over some longer time period, they may not have enough money in the moment. Or if they have money in the moment, they may not have the confidence to be able to invest that money because of risk that they're not going to have that money in the future. And that's the problem of illiquidity. So being able to move money from one period of time to another. Sometimes you need to spend a large sum in all at one time. And so you need to pull income from the future into the present, or draw income from the past into the present. Sometimes you need to take a big lump sum and you need to spend it slowly over time. So you need the ability to keep it safe so that you can take small amounts. If we conceive of microfinance as providing the tools to confront this reality of insufficiency, instability, and illiquidity, of providing the tools to manage liquidity, manage investment, and manage risk, that helps us think about what household needs are and what product needs are to help us deliver products that are better suited to the needs of customers. Now, there isn't a clear mapping between these needs and the products. Each of the main four products of microfinance can be used to meet multiple of those needs. Payments, credit, savings, and insurance all help people accomplish those different needs. Credit can be a liquidity management tool. It can be an investment management tool. It can be a risk management tool. We've seen, for instance, in the pandemic, how important additional credit has been to many small businesses to be able to manage the risk inherent in coping with the pandemic. Of course, we've seen the credit's role in managing liquidity and, of course, in managing investment. Savings have played a vital role too, and have been a big part in many parts of the world of MFI's stability, that their ability to motivate savings has protected them from some of the ups and downs of the pandemic. So if we're going to have a clear path forward, I do believe we need to start rethinking all of our products and the specifics of how those products are delivered, not so much around a single idea of microcredit as a small business loan, but all of these tools, payment, credit, savings, and insurance, as tools to meet these core needs, to manage liquidity, to manage investment, to manage risk, so that households can cope with the challenges not only of insufficiency, but also of instability and illiquidity. Now, I'm sure much of the conversation for you at this conference and in your own institutions has been all about a digital transition. We've been talking about digital transitions in microfinance for quite some time. The theme of the 2019 conference was demystifying digital. But progress has been slow until the pandemic. And my friend Greg Chen from CGAP has this phrase that I love to borrow because it's so perfect for the questions that confront us on the digital side, is that digital can build bridges and it can dig moats. So the digital revolution that we've seen in talking to the Sentinels and watching MFIs, they've really been nudged hard, pushed hard into leaning into digital because of the pandemic and lockdowns, using WhatsApp and other ways of communicating with customers, starting to accept digital payments and working with customers to get them comfortable with digital payments, designing products that can be delivered digitally, reaching out to customers, the end of in-person meetings, and figuring out ways to use digital tools to maintain customer relationships. That's been an incredibly important bridge that has helped both MFIs cope themselves, but also their customers cope. And it's been amazing and wonderful to see the innovation and the resilience of microfinance institutions around the world in using technologies to build bridges. But at the same time, digital can be a moat. It can be a barrier to the traditionally marginalized customers that microfinance was invented to serve. The overlap between poverty and digital illiteracy is very, very high. The overlap between difficulty accessing the technologies and rural customers is very, very high. And so there's a concern too that digital not only can be a bridge, but if it's not used very intentionally, it does create barriers. It makes it even harder for the marginalized customers to engage in microfinance, to connect with microfinance institutions, to figure out how to make finance work for them. And that's traditionally been a big part of the work of microfinance. It's one of the reasons it's so very, very difficult to do is microfinance institutions have taken up the challenge of reaching customers who are thought to be unreachable, of bringing people into the system who are thought to be well beyond the system, outside the castle walls, you might say. My fear is that in these transitions that are happening very, very rapidly, that it's very easy to lose sight of the people who are not making the transition. If we're only using digital tools, or as we rely more on digital tools, it tends to erase or hide the people who are not there. So, there's this mythos around digital and the internet, the idea of mass customization, that these digital tools allow you to deliver a customized product to every customer. And that myth is not entirely unfounded, but it's not really the whole story. Much of the story of digitalization is about homogenization, about delivering the exact same product to a very large number of people. That makes it very cheap. It changes the economics of delivery often, and therefore means that more mainstream institutions may be more interested in serving some of the lower income customers because they can serve them more cheaply using digital technology. However, that homogenization also is directly contradictory to a lot of the idea and the success of microfinance of holding hands, of going to the people to work with them, to bring them into the system, to customize products to them, to help them engage with the financial system that they may not be comfortable with. And so I think we have to constantly confront this issue of what digital is going to do, how we use it to customize rather than homogenize, how we don't allow a huge swath of customers to be newly excluded by a digital moat. Now, this does present a very specific challenge to microfinance institutions, because if digital technologies allow more mainstream financial institutions to shall we say, cherry pick the customers who are comfortable with digital, who are also likely to be the wealthier, better off, more savvy customers. That puts a lot of pressure on microfinance institutions, potentially losing some of their better, most profitable clients and putting more pressure on their on MFI's own finances. And so it is important that MFIs invest here and work really hard to maintain what's distinct about microfinance, maintain those client relationships, and not lose sight of microfinance's role of bringing more people into the formal financial sector. And of course, there's another big concern that I worry doesn't get enough attention. And I hope you'll forgive me for using the memes to illustrate this, but cybersecurity remains a very, very big problem that I don't think is getting nearly enough attention in global circles around microfinance. As I've mentioned, many of the customers that microfinance focuses on are less technologically savvy. And so they are more vulnerable potentially to cybersecurity risks. And, we're not going to solve this problem with digital literacy. I have spent a lot of time looking at financial literacy, which is often put out there as a way of fixing financial inclusion. And the fact is, financial literacy does not work. It does not make a meaningful difference in outcomes. And that's because it's incredibly hard to teach knowledge to people and change their behavior. Changing behavior is a very different set of interventions than teaching knowledge. Digital literacy is not going to fix the cybersecurity problem. So we've got a problem on the customer side of cybersecurity, but we also have a big problem within MFIs on cybersecurity. Dealing with cybersecurity is incredibly difficult and it's constantly changing. And the people who know what they're doing are expensive and in very high demand. And microfinance institutions around the world are struggling to build a robust and secure digital presence because the people who can help them do that are being hired by the banks and many other organizations who can afford to pay very, very high salaries to retain those people. And so MFIs are really often caught in a vice. They don't want to expose themselves or their customers to risk, but they have a whole lot of expense and difficulty of ensuring their security. And so this is something I'm going to be watching very, very carefully over the next couple of years as we've made this very, very rapid transition to digital because of the pandemic. How do we manage the questions of cybersecurity? I'd love to hear from you on how that's happening in your institutions and how you're managing cybersecurity risks effectively within an MFI framework. Now, all of that being said, I'm going to minimize things and wrap up here to say, I am very encouraged about how microfinance has weathered the pandemic. I'm very encouraged that the institutions have by and large remained strong and found ways to meet customer needs. And I truly believe that microfinance institutions are going to be need to be a bedrock of the recovery from the pandemic. And so let me close by giving you my best wishes, both for this conference, but also on that uncertain road ahead, that microfinance institutions and microfinance leaders have done amazing work. There's hard work ahead, but absolutely vital work to the recovery of countries and of communities from the pandemic. Thank you for your time, and please do reach out with your ideas on how the road ahead is looking for you. Keep track of the Sentinel project, and I will look forward to being with you again in person next year.